Then you go to a more diversified fund which are across sectors, right? You start learning more sectors.
Tell us what is SIF and how it is differentiated vis-a-vis your mutual fund as a product.
Yeah, so see, SIFs are specialized investment funds. What we were doing is fundamental long only, which is MF. I will start with the line that there is a lot of misconception around usage of derivatives in SIF.
Can you please spend some time on how you run your hybrid long short and your equity long short? What framework you carry there?
The hybrid long short which we have is positioned more like a BAF plus. Like I said earlier, different funds are positioned very differently.
Hello to all of you. आज we have a special show on the SIF which is specialized investment fund और आज हमारे साथ में जो मेहमान हैं वो टाटा म्यूचुअल फंड से सूरज नंदा फंड मैनेजर फॉर अ स्पेशलाइज्ड इन्वेस्टमेंट फंड तो थैंक यू फॉर कमिंग डाउन पर्सनली
Thank you.
रियली अप्रिशिएट योर टाइम तो हम before we start the discussions, I generally wanted to understand how your journey started since 2016. That's where I think you started your journey. So why didn't you spend some time and tell us your journey for last 10 years?
Yeah, so I started my journey on the buy side with ICICI Prudential AMC, where I was hired directly from college, and I was given a sector on the first day. And given the theoretical knowledge you learn in college, it was difficult for me in the first 3 to 6 months how to apply that theoretical knowledge on the practical side, because stock markets are not easy.
Correct.
Right? You can be very positive and the stock not performing, and you can be very negative and the stock going up. So to make a sense of everything, no, it took a lot of time. And then you have good mentors there, which help you, in understanding the markets, how to be patient, have good temperament, and apply the basics, right? And over a period of time, it's a job where you have to learn by getting your hands dirty. So you have to give calls. That is what we got the message from the top, that you have to take calls, right? And once you start taking calls, you'll understand where you are going right or where you are going wrong. What is your style? Everything you will understand, right? What you are more comfortable with, right? And it's a process which you learn, and that is what happened in the first 4 or 5 years. Uh, you develop a style, you learn what worked for you, what didn't work for you, how to analyze companies, right? What should you look at in a promoter, right? So these are the things which you learned over the first 4 or 5 years as an analyst. And then given that we were sector analysts, so we start with few thematic funds, because those funds, at least you are more conversant with the stocks. So that is what is the first experience you have on the fund management side. And then you go to a more diversified fund which are across sectors, right? You start learning more sectors over a 3-4 year period, which I did. And then there was an opportunity to manage a fund on the long short side. So we had a AIF long short department where we were launching a hybrid long short fund, the enhanced dynamic equity fund. And we wanted to do a BAF plus positioning. So that is what was the first fund on the long short side which I did. And given the approach, which is much more fundamental nature for me, so it was a fundamental long only plus a fundamental long short, right? What we have on the mutual fund is a fundamental long only.
Correct.
So it's just that you have to add that fundamental long short to it, and that is how we managed it over the 3 years. And the product, gave the returns, or the expectation met the expectation for the investors very well, when we said that we'll do BAF plus, and we were able to deliver over that 3 year period. So that was my first 10 years of experience on the buy side.
Great, excellent. Probably I'll keep the learning part maybe later part of our discussions.
Yeah.
Let me start straight on the SIF sides. So why don't you tell us what is SIF and how it is differentiated vis-a-vis your mutual fund as a product?
Yeah, so see, SIFs are specialized investment funds. Now, in that, like I said, what we were doing is fundamental long only, which
Correct.
is MF.
Hmm.
And in SIF, basically, you have long only
Hmm.
plus long short, right? But then you had it in AIF also,
Hmm.
right? But see, the in AIF versus an SIF, the taxation is way more simpler because you come under the mutual fund regulations and you have mutual fund taxation
Correct.
versus an AIF where you have business income tax and the taxation is a bit more complicated.
Hmm.
But the main difference between a SIF and MF is that in MF you're only playing the long side of the market.
Hmm.
So if the markets are doing well,
Hmm.
you will be happy with the output.
Hmm.
But when markets correct, the returns look worse for the
Hmm.
investors.
Hmm.
What SIF is designed to do is participate on the upside,
Hmm.
but help protection on the downside,
Hmm.
because that is what the derivative instruments which SIF has
Hmm.
is designed to do
Hmm.
for the investors. So the objective of SIF is to focus more on the risk part,
Hmm.
give a better risk adjusted returns to the investor.
Hmm.
Whereas on the mutual fund side, we focus more on the return side,
Hmm.
right? How do we beat the index?
Hmm.
That is what the major, criteria is. Here, I'm not saying return is not the main focus.
Hmm.
Return is there, but how you give a better risk-adjusted return over the cycle?
Hmm.
How are you playing that entire market cycle?
Hmm.
When do you increase the risk? When do you reduce that risk?
Hmm.
Right. So that is what these funds will do versus an MF.
Hmm. So is SIF is designed for a specific segment of the client?
Uh, See, the minimum investment criteria which we see in SIF, it
Hmm.
may look like that.
Hmm.
That when you have a 10 lakh minimum investment,
Hmm.
it might look like it is designed for a specific client
Hmm.
or an investor who has that kind of or a maybe an HNI or a slightly more, wealth. But I think it's a product which is for the retail. In
Hmm.
AIF, obviously, the minimum requirement was way more high at 1 crores,
Hmm.
but at 10 lakh, I think, and it might get more simpler and lower going forward in the future.
Hmm.
But I think it is designed more for the retail part,
Hmm.
so that their experience in the market is much more smoother
Hmm.
than what you see,
Hmm.
right? And that is what SIF will solve. It will
Hmm.
give them a much more better experience in terms of risk in the
Hmm.
market.
So there are many strategies are there in the market which can protect the risk which is not available via mutual fund, and hence the SIF comes into the picture.
Yeah, so see, in mutual fund also, if you look at the risk return,
Hmm.
you know,
Hmm.
the bottom you start with is arbitrage,
Correct.
because there is zero risk.
Correct.
Then you have equity savings. As you increase that net equity, the risk increases.
Correct.
Arbitrage, equity savings,
Path.
then BAF, then
Hmm.
aggressive hybrid, then you have diversified equity funds, then you have thematic funds.
Correct.
So that is how the risk increases. Now, what SIF is designed to do, it is designed to reduce that risk
Hmm.
even in a long only. For
Hmm.
example, in equity long short
Hmm.
funds,
Hmm.
what we are trying to do is give a flexi cap or a Nifty plus returns, but with a lower volatility than Nifty,
Hmm. Hmm.
right? So if you are able to do that,
Hmm.
automatically, the product will fall on the efficient frontier,
Correct.
right? If you are able to give a similar return like a flexi cap, but with a
Hmm.
lower risk, logically, which fund will you select?
Correct.
Right? So that is what these products will do. It will help in managing the risk better, and over the market cycle,
Hmm.
as go through that bear bull sideways market,
Hmm.
you will see that the output is way better with
Hmm.
the lower volatility.
Hmm. Hmm. So how many frameworks are there within the SIF? So within that framework, which are the sub frameworks are there?
So within SIFC, there is an equity, hybrid, debt.
Okay.
These are the three major categories within SIF.
Okay.
Obviously, there are no products which we have seen under debt SIF as of now.
Hmm.
In equity, there are three products. One is equity long short, then you have an X top 100,
Hmm.
and then you have a sector rotation fund.
Correct.
In hybrid, we have two products. One is hybrid long short, and you have an
Asset.
asset allocator
Hmm.
SIF. And each of these products are designed to do differently. Like, equity long short, I say that they complement the products on the mutual fund.
Hmm.
Equity long short can complement a flexi cap or a multi cap fund. X top 100 can complement a mid cap or a small cap fund. Sector rotation can complement a thematic or a business cycle fund.
Okay.
Hybrid long short, in hybrid strategies, what we have seen that unlike the mutual fund category where each category is defined perfectly,
Correct.
that a BAF fund will have a BAF category will have all the BAF funds.
Correct.
Aggressive hybrid will have all the aggressive hybrid funds. Unfortunately, in hybrid long short, we don't have that. Every fund is positioned very differently, right? So we have seen an arbitrage plus kind of a product, we have seen equity savings product, we have seen income plus arbitrage product, and we have also seen a BAF plus, which we are doing. So it becomes a bit of an apple versus oranges in the hybrid long short category. And as a result, the investor has to be an extra careful, not just look at returns,
and not
right?
just look at the name.
Yeah,
and then go.
just don't look at the category and the returns to decide which fund to invest in. Rather, you should understand what the fund is positioned for, right? Whether it's a BAF plus and it fits into your investor criteria, you should do it. If you want an arbitrage kind of a product, you should go for that kind of fund. So one has to see the returns, beta, risk to understand what the positioning is, and then take the final call.
So any regulatory guardrails are there to differentiate SIF versus mutual fund?
See, regulatory guardrails in the sense that the thing is that one is you can't cross 100% of the exposure,
Okay.
which is same as MF.
Okay.
So there is not difference in that. But the ability to do short in this fund is the differentiation, the naked short.
Okay.
In MF, you are doing short, but you are doing it as an arbitrage. That means you have it in the cash equity and you are shorting on the future side.
Correct.
In SIF, you can do naked shorts. But there are guardrails in the sense you can't do more than 25% of your exposure. So that is one difference which is there versus a mutual fund. The second difference which is there, if you are doing hedging, for example, using covered calls. In mutual fund, the covered call is limited to Nifty 50 stocks. It is limited to 15% of the portfolio you can do as covered call, or 30% of the position of the stocks. Now, these kind of limitations are not there in SIF. So you can do the entire portfolio covered call, given that your entire portfolio is in FNO. Right? So these are the same, major differences which are there. One is the ability to go naked short up to 25%, and the second is doing a significant covered call, which NMF cannot do.
So this almost in most of the schemes have in the name the long short. What does it mean, this long short, when it comes to in SIF context?
See, a long short in SIF context is, like I said, an ability to go both on the long as well as the short side, right? You are not designed to play just the bull market. You are designed to play the bull, the bear, the sideways market, everything. Right? That is your ability, which a long only fund does not have.
Correct.
Right? And the ability to use derivatives to play these cycles is what makes it a long short. So that in the bull market, anyways, you will be having more long positions. As you are entering the end of the bull market and going towards higher valuations, you have to move towards short, right? When you are moving from bear to a bull, again, you have to book profits on your shorts and take more longs to increase that net equity. So it is your ability to navigate that market cycle using derivatives, which will have both long as well as short.
So is as a fund manager role is very hyperactive role vis-a-vis the mutual fund manager role?
See, I would not say that it is more like a hedge fund where you have to be very, very hyperactive.
Okay.
But the thing is to understand where you are in the cycle, what net equity or risk you want to run in the product is what is the most important thing. Obviously, it requires a more work, because you are not only looking from the long perspective, you're also looking from the short perspective. So your idea generation is on both sides of the market, right? The thing is, on the long only side, you are only searching for buy ideas.
Correct.
Here you are searching for both buy ideas and sell ideas.
Correct.
Right? So automatically the work in that kind of a scenario increases.
Okay. Uh, what role derivatives plays in the SIF context?
See, I will start with the line that there is a lot of misconception around usage of derivatives in SIF. That people think that derivatives increase the risk in the portfolio, right? Whereas what I think is that the role of derivatives in SIF is to reduce the risk for the investor.
Interesting.
Right? Because if your the ability to manage that risk for the investor over the market cycle is what is done using derivatives, right? Uh, I would say SIF is a lower risk product than a long only mutual fund over the market cycle.
Oh.
And that you will see as people go through that 3-4 year period. You will see that the volatility in these funds will be lower than what you see if followed to the rules of the game. If you follow to that rules of the game, you'll see that the volatility in the SIF kind of products will be equal or lower versus what you see in a long only.
So what are the controls maybe as the AMC or a SEBI had put in to control the risk comes via derivatives?
See, one is see what SEBI can do has done is give a broad guideline. They have not allowed us to use leverage. So if you look at AIF long short, there was a leverage which was there where you could go to 200% gross exposure. Here we are like a long only MF, we can't go more than 100. So anyways, the margin requirement is itself not significant that there could be a margin call if you have gone wrong significantly. So that risk is not there because the position itself is not there to that extent. Um, the second thing they have done is put a restriction on the naked shorts which you can do, which I spoke about earlier, 25%. The third thing is how much you can take in a single stock, which they have said either 5% or 10%, they have said. But the thing is, see, the risk is they have given the broad guidelines. Now, how much sizing you do is on the fund manager, right? Like on the long side, how much weights you build and how much comfortable you get with each, sector as well as price. You build that, or valuation of the sector, you build that weight. Similarly, you on the short side, we have to look at sectors which are at the peak of their cycle, where the margins are at the peak, where you think that the supply is coming in and the margins could come under pressure. So in that way, we have to keep on slowly building that position. It's not that you'll go to a 1% or 2% position on the first day and expect things to work out for you. So you have to build it slowly, build 4.4, 0.5%, and then gradually you have to keep on revisiting the thesis, that whether your thesis is right, and that is where it works out. But the only difference is that the time horizon for a short is generally lower, right? Because we have seen bear markets to be sharp, bull markets to be long term. You see bear markets like this, bull markets are like this. So in the stocks also, the same thing works, is that they correct very fast. So you have to book profits. Because see, the long only industry is very big. They will always be fishing for such stocks. So you have to also be nimble in terms of booking profit and finding the next ideas.
So let's say suppose you have short in your books, and what if the market moves sharply against that trade?
Yeah, so see, the way we look at short is that we do a paired long short.
Okay.
In paired long short, what happens is you have a long on a stock in a sector and you have a short on a stock in a sector. So what we look at it as a pair.
Okay.
That the long which we have is based on fundamental thesis that this company is a market share gainer and it will do better in this kind of a earnings cycle which is there. And the short one is a market share loser. There is no they are not able to manage the cost well, or they don't have a model pipeline, and their earnings will not be as expectations, right? So in that way we position it, and the payer has to deliver, right? And we have those quarterly results which will come 4 times a year, and the results will be visible in that. So that is how we look at it. The payer has to make me money. So the short is a naked theoretically, but we look at it as a payer, so that there is no asymmetric risk. Now we don't do a auto sector long with a cement sector short, because if there is a GST cut kind of a scenario which happened last year, auto sector will do well, but your cement sector will not do well. Correct. So you can't do long short across sectors. We do it within the sector and look at it as a pair, that the pair should make you money.
Interesting. Can you please spend some time on how you run your hybrid long short and your equity long shorts? What framework you carry there?
So see, the hybrid long short which we have is positioned more like a BAF plus. Like I said earlier, different funds are positioned very differently. That is why knowing the positioning of the fund is very important. We have done it as a BAF plus just because the structure is superior to the BAF structure which is there in the mutual fund. You have a very significant debt which is 25%, and that earns that 8% yield as per the current yields which we are seeing in the market, right? On the 75% of the portfolio, we are able to navigate that net equity way more flexibly than a BAF, from 0 to 75 versus the BAF doing between 30 to 60. And given the derivative instruments, we are able to do it more efficiently. You have the flexibility, plus you have more instruments to navigate that flexibility more efficiently, right? Because in a BAF, you are majorly using arbitrage or hedging, right, to move that net equity. Whereas here we have arbitrage, more covered call ability, the unhedged derivative, like I said, about the paired long short, thematic shorts, thematic longs, and that helps us to move it more efficiently between that range. The structure of the product is such that out of 100 rupees, 25 is debt, 55 rupees is your cash equity, and the remaining 25 we use it as margin for the derivative exposure. So that derivative exposure will be used to move that net equity dynamically. So that is how the hybrid long short fund is. The construct of the portfolio is more large cap oriented, given the volatility and beta of the BAF category. So 80% would be large cap, 10-15% mid cap, 5-10% small cap. We do have REITs also in the portfolio because it is part of equity. So around 2 to 5% we do have currently. So that is how the hybrid long short is. We have completed 6 months in that product now. The equity long short was launched in the month of May. It is positioned more like a flexi cap plus positioning, where the objective is that you are able to navigate the risk way better than a long only fund. And we try that by using that net equity, where in equity long short the net equity can move between 0 to 100 versus what we saw in hybrid long short between 0 to 75. And the difference versus a long only fund in equity long short is that a long only will have net equity between 90 to 100 at every phases of the market.
Correct.
Now it is the ability of the equity long short fund to traverse that 0 to 100 as per the risk in the market. That is what will generate alpha for the investor. See, the alpha generation, like I said earlier, will come on the downside, because the maximum net equity which an equity long short can go is 100.
Correct.
And the maximum net equity which a long only fund can go is 100. So logically, keeping aside the stock sector selection, we are not designed to beat a long only fund in a bull market.
Perfect.
But it is our ability to go lower on the net equity part on the downside, which will protect the downside way better for the investor.
Perfect.
And that will generate the alpha over a 3-4 year period. So these are all market cycle products, and will give you a much better risk adjusted return. The volatility will be lower than a long only product, and you can get a similar or a higher return with a 3-4 year period. So similarly, logically, if you have a risk return graph, you have a product with a given return and risk, and you have a product on the left side, that means lower risk but similar or higher return, you should be going with that.
Perfect. So as you rightly, as you said that in both the product you have ability to come down up to 0 to 75 or 0 to 100. Do you emphasize that you will able to use that 0% as an equity exposure at any given point in time? If at all, in what sort of scenario do you expect those things?
See, the thing is, see, these are extreme scenarios.
Correct.
To go to zero or to go to 100, it has to be a very volatile kind of a market. So, if you remember in 2024, we when I was managing a hybrid long short fund on the AIF side, by September 2024, our net equity was around 10%. Right, and that is where you follow the model, right? Because in a bull market, the human psychology will be to be more positive. In a bear market, the human psychology will be to be more negative, right? But if you have a model which is a counter cyclical valuation model, it will tell you to reduce the net equity at the peak of the markets. Perfect. It will tell you to increase the net equity at the bottom of the markets. Correct. And that is what we are designed to do. And what happens is it keeps rationality in our minds also, right? And we did it in September 2024. Obviously, you can't say that I have reduced the net equity today and the markets will fall tomorrow. Correct. See, the timing is the most difficult part in this. Perfect. So that is why we do it gradually. So from July to September 2024, post elections, we kept on reducing that net equity from 40% to 10%. And then the markets corrected, right? But we do it as the model says. We keep on reducing it. Similarly, if you see in the month of March, the markets corrected 12%. We increased that net equity to from 52% to 61%. So following the model helps significantly in terms of going to 0 or going to 100.
Any particular scenario comes in your mind which you think the maybe the product will underperform in such scenarios?
See, if you look at a complete kind of a late stage of the bull market,
Okay.
because see, we have to reduce that risk when the valuations are becoming expensive.
In that window, I think.
In that window, it will underperform because a long only product will be running between 90 to 100%, but we might be at 70, 60, 50. You never know at what valuations. So automatically, the returns will be also lower for that period of time. But those periods will be always there. But over the cycle, whenever the bear market comes, you automatically cover up the loss of returns.
Is there any, do you have some frameworks where such flags or such triggers will either you will increase or decrease your short exposures?
See, generally, the model which we have, it has multiple parameters. We look at Nifty trailing 12-month earnings. We look at Nifty 500 trailing 12 months earnings for the broader market. Okay. So that it incorporates the mid cap, small cap also. Perfect. Then we look at price to book. We look at earnings yield minus bond yield also. Because see, if you see in the month of March, we increased it to 60, but we couldn't increase it further to 70. Because the bond yields itself were going up significantly, right? Because of the crude, right? So there was a negative factor because of that, right? So there are multiple factors which we look at: market cap to GDP, cyclically adjusted P, what is the profit as a percentage of GDP, because we are also entering at the peak of that kind of a scenario, right? So we all look at those kind of parameters to understand how much aggressive we want to be or how much conservative we want to be. Like I said earlier, the beta of the fund has to define where you are. Correct. If the beta has to be increased when the valuations are becoming cheaper, and beta has to be reduced when the valuations are becoming expensive. So in that way, we look at it. When we have to reduce the beta, we increase the shorts. Correct. Or move more towards large cap. When we reduce the beta, we generally have more long. We increase the beta, we generally have more longs, move more towards small and mid cap in that way.
So in your experience, whom to avoid this product, who are not the right segment to allocate SIF as a product?
Oh, tough question. So, not the right segment, I would say. People who are, having a very short time horizon. right? Because see, expecting a return, quick returns in this kind of a product in a 1 year, it's not made for that, right? Like I said, the beauty of the product will be visible across the market cycle. So anyone having a very small time horizon, this product is not suited, because see, this product is not that, it will not be that aggressive to give you that super normal returns in a very short time frame, right? I think time horizon is the biggest factor. Anyways, the risk itself is lower, like I communicated earlier.
Correct.
Anyway, the person who has a shorter time horizon and has a higher risk capability should avoid.
So the product construct is more like a model driven or a fund manager discretions or combination of both.
See, it has to be always combination of both. Like I said, model is designed to bring rationality in terms of what, how much aggressiveness you want to have, or conservativeness you want to have. Whereas a fund manager discretion helps in identifying which instrument you want to use at what point of time, right? For example, if you want to reduce that net equity at the peak of the bull market, you don't directly go and short at the peak. You start by doing arbitrage, start by doing covered call, start by buying some put options because the VIX is lower, and then you start doing some paired long short, right? Because the pair will not make you lose money significantly. And then when you see that the things are taking a turn, then you go with maybe short thematic shorts kind of thing, which are more aggressive. So you have to follow that process. The discretion has to be there when to use what instrument to get to that desired output. But the model tells us where you want to be, right? So you have to reach there in your discretion. It will tell you to go to X net equity. Now, how you want to go to that X is your discretion.
So within the fund house, is there any checks and balances are there where fund manager is not excessively using his the discretions? Do you need to go to the investment committee if you certain threshold cross or certain lines gets crossed?
No, so the risk team and the investment committee was always there. So
Okay.
we have it monthly investment committee, and the risk team, monitors the product daily.
Oh.
Right, so our gross exposure is checked, our naked positions are checked, whether we have
Within the stipulated.
within the stipulated we have that naked position or not, how much naked positions we have, right? That is also checked. So in terms of margin, how much we are using, that also we look at. So all the things are there in place. In terms of the regular day-to-day monitoring is done by the risk team, and obviously you have a monthly and then a quarterly kind of an investment committee where we discuss how the strategy has been working out.
Is the skin in the game rule is also applicable to the SIP?
Yes. So for me, obviously, like in mutual fund, you have the similar. Given it is a part of mutual fund regulation, so it's the same rule.
Though we have a limited, let's say, suppose history of SIF or a track record, but whatever the time frame we have you find any misconception about the SIF in the maybe investor community or maybe in the advisor community?
See, I think the misconceptions are both extremes, which I have heard. One, what I got to know is that the product will never give negative returns, right, when the markets fall. So that is one misconception which I want to make clear, that the product, at least what we have positioned the product for, there is always a net equity exposure which is there.
Correct.
So when the markets fall, we'll fall. But the objective is to fall less, way less than the market. Right, so that is one misconception which is there. And the second thing which people say, that the product should be higher risk, right? And what I think is that the product is not designed to be a higher risk, right? Because like I said, the use of derivative is to reduce that risk for the investor or smoothen the volatility for the investor over a period of time. So that is how the investor has to be communicated.
So again, when we talk to the lot of clients, people think that because it uses a lot of derivative strategies, it also has a capacity to give you supernormal returns. Is that the sort of whatever the thought process, is that the right, or this is also comes under the misconception?
See, this is a misconception. The reason is that, like I said, the maximum gross exposure you can go is 100.
Perfect.
Right. So if I am allowed a leverage like what I had in AIF long short,
Hmm.
I can take that net equity to 120, 130, 140%, and then an investor can expect a super normal profit out of me, which the AIF segment is designed to do, to take a higher risk, right? But when my gross exposure is capped at 100, like how to do, the product is not designed to do a very super normal, unless you are taking a very, very significant risk, which you don't want to take.
Correct, correct, correct. I'll also take this opportunity because you are also part of the investment team. So just wanting to understand where do we stand in the market cycles, and how do we look at if, let's say, someone has a surplus and incremental other investment amount, and if he's looking for 3 to 5 years. So if you can give some, like your thought process on that side.
See, in terms of the cycle, if you see, the best way to look at is what the corporate profit to GDP is, and that is almost at the peak, is what we are seeing right now. So the thing is, will the economy go through a slowdown? Is the question. Obviously, we have seen signs of slowdown, right? So in that kind of a scenario, what I would say is that mid caps and small caps have obviously run way, way higher. And obviously, there's a geopolitical risk which is still continuing. Crude is a very significant import item for India as a country. The fiscal will get stressed, right, if it goes on for another 2-3 quarters, and which will impact the growth, in the sense, because the government capex will be cut, and you never know what will happen in that kind of a scenario. So one has to be careful how much weightage one needs to have on the mid cap and a small cap part. You can do bottom up and find ideas, that is there, but generally, as an index perspective, if I see from top down, obviously it has been at the peak right now. Whereas on the large cap side, there is a lot of FII flows which have gone out, and as a result, the valuations are around fair levels, is what I would say. Right, it's not overly expensive, but it's not overly cheap also.
Correct.
So in that kind of a scenario, no, it becomes a very moderate return kind of a market for us. So either you have to wait for the demand in the economy to pick up. For that, the geopolitical scenario has to become normal. The demand pick up in the economy happening, and as a result, the nominal GDP going back again to double digit with real demand growth, and that will lead to kind of some re-rating in the market, because active FII flows will come back. Other than that, then the only option is to see some correction in the market, and then you see a good, decent upside, right? So we have to look at sectors which have underperformed and take positions based on that. But one has to be clear, it's a moderate return kind of an environment.
You also said that obviously in last 2 years we have seen that the economy is slowing down, and that has an impact in terms of even on a EPS growth also. So do you think in the slowing economy the market will become a polarized the way we have seen in maybe 2017, 18, 19, that sort of thing? Are you getting that sense?
I think we are. See, wherever there is growth, there is too much money chasing those stocks. And as a result, you see that kind of a disparity on the valuation side, right? And if you see, the cycles are also getting shorter.
Correct.
Right? Anything and whatever people see is, has a higher growth than a nominal GDP growth, is, capturing that part or return valuation way higher, way faster than what it should be. So basically, what you wanted to make in a 1 year, 2 year perspective, you're making in one
One
quarter.
quarter.
So that is the kind of problem which is there when the growth is a bit slow. Opportunities are also lower in that kind of a sense, and too much money chases few stocks. So one has to be also careful on that sense.
So do you also think that the amateur investors, if they are dabbling in the direct stock market or building a direct stock portfolio, maybe they might underperform because they have superly outperformed maybe in the 21 to 23, 24 sort of thing, where they even low quality have done well. But in this environment, what we have explained, in that environment, do you think that the people like you, which are investment professionals, might do a job better because it's a stock pickers market? It is not something which is broad based market.
I think you are right in saying that it's more of a bottom up market, because see, 21 to 23 was a top down market.
Correct.
Right? We were coming from a very low earnings to a very high earnings, so it was a easier market for everybody to make money, right? And you can hear it from your friends, relatives, everybody will have some view,
Correct.
right? But now if you see, when I say cycles are shorter, too much money chasing too few stocks, for a retail investor to do that is not easy, unless, I'm not saying they can't do it, but you need to give time. It's not just looking at price and doing it. So you need to be bottom up analysis to understand where the company is in the cycle, right? Where is the earnings, whether the earnings are peaking or the earnings are bottoming. So in that sense, one needs to understand the cycle, which again becomes a full-time job for them, right? If they want to do that, then it's very good. But if they don't want to do that, then I think
People like you
this
are
is not the time to do dabbling in stocks
correct.
just based on technicals or anything. So better to and markets are tough.
Yeah.
We have seen over the last 1 year,
Yes.
and with such so many events happening, you have tariff, you had a trade deal, budget day volatility, AI risk across sectors, war scenario. So there are a lot of events. The volatility in the market is extreme, right? So it becomes difficult in that kind of a scenario for a retail investor to capture everything and do it, right? And at least in that kind of a scenario, an investment professional is better equipped to at least protect on the downside.
Correct. Give me your views on maybe on a market cap or a sector or a theme which you like and which you don't like.
So, themes which we like is one is power sector. I think because of monsoons, the stocks have also corrected because the peak power demand kind of falls during this kind of a season. But the demand for power is going to be structural, because I think AI is here to stay,
Yeah.
because it will get incorporated in everyone's life, like what we have seen with so many inventions over the last 100 years, right? So and for AI to work, you need power. If you see US, the only constraint they have is power,
Correct.
right? So power, I think, is demand is here to stay, and it's I think more structural way of looking at it for a 2 to 3 year perspective is what I would say. Then banks, I think private banks have corrected significantly. Their valuations are very favorable, and I think whenever and if and whenever FIs return, I think banking will be the sector which will do very well, because that liquidity is available with the banks. Correct. Only. Third thing I would say, and insurance as a sector is also very cheap. But obviously the caution here is the regulatory angle which is there. So you cannot say that I will sit tight on insurance stocks. You will get opportunities to buy when the regulation risk comes.
Correct.
But once the risk goes away, you have to lighten up your positions also. So these are the three segments which I like. What I don't like is I would say on the FMCG side, few stocks continue to be still expensive
Mhm.
despite a lower growth. Margins are still at its peak. To uh, for that growth, it becomes difficult to justify the valuations. Um, Within the, I think the mid cap and small cap space, I would say the valuations, mid cap specifically, has gone, uh, way higher. If you look at a mid-sized private bank,
Mm.
it will be trading at a higher valuation than an HDFC and all,
Mm.
right? So it becomes difficult to incorporate some of the valuations in your valuation framework
Mm.
on the mid cap side. So I think one has to have a lower weight while running a fund on the mid cap side
Mm.
to reduce that risk.
Mm. Mm. So we started these conversations with your journey. Like genuinely wanted to understand, like with your 10+ years of experience, what are the key learnings are you are deriving from a market? Uh,
See, the key learning has to be, see, what I have learned is that whenever I have gone momentum, I have gone wrong, right? So generally, that fear of missing out,
Hmm.
always leads to a mistake,
Hmm.
right? So I think rather have no position,
Okay.
right? Or if you maybe on the short side also, because I have that panic attack if I am short on a stock and it keeps on going up despite the earnings not being favorable. So in that kind of a scenario, if you follow momentum,
Hmm.
it doesn't work both on
Hmm.
the long and the
Hmm.
short side.
Hmm.
So you have to be clear at what price you are entering, and what is incorporated in the price is very important, right? Like the way I look at metal sector, what metal price is incorporated at the CMP,
Hmm.
right? That is where you get to know what are you paying for what price, and then you can have a view on the LME,
Hmm.
whether it is going to go up or down,
Hmm.
right? So I think FOMO is something which I will always want to avoid.
So
Uh,
trend you don't want to chase.
yeah,
This is what you are
yeah,
saying.
yeah. Then having the ability, because I learned it from my previous organization, having the ability to take pain.
Hmm.
So you have to have that temperament
Hmm.
uh, to to stick to your calls,
Hmm.
right? As an analyst, also, I went through that phase where I stuck to my calls,
Oh.
right, and it did play out.
Hmm.
But when it doesn't play out, obviously the confidence takes a hit. But what I have seen that over that period is that uh, generally, if you buy something cheap, you will make money,
Hmm.
right? So the objective of me as a fund manager is always try to buy at a price where the risk reward is favorable and I don't lose much money,
Hmm.
right? So that is the framework I follow.
Hmm. Interesting. So, any sort of the advice from a mentor is still there with you, and you are still carrying those advice. Any one advice you would like to share?
See, one advice which I got is to be, always be patient in your approach, uh, be humble at the peak, at the bottom,
Hmm.
right? And have the right attitude and temperament
Mm-hmm.
uh, towards stock selection as well as general life. So those are the three things which I was, mentored. I learned patience and temperament directly from him because he's a long-term investor,
Correct.
right? Who has gone through that cycle. So that is the biggest thing you learn, and that gives you that confidence to hold on to, the stocks,
Hmm.
which we used to do as an analyst looking at him,
Hmm.
right? So that is what you learn. So that is what I want to incorporate, how you study stocks,
Hmm.
how you size positions.
Hmm.
So those are the things which you learned
Hmm.
over a period of time.
Hmm. Any one personal finance habit you are still struggling?
Uh, I think I'm more of a miser, so I'm not struggling on the expense side.
Uh,
uh, um, um, so I don't think. I think the problem I face is you should spend more or enjoy more rather than saving.
Acha.
But that has been the which has been incorporated since
In
childhood,
childhood.
maybe. We have a very savings mindset,
Mindset. Yeah.
and but there has to be a balance.
Yeah. 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 So maybe any one or two things which has worked for you, like wherever you are there in your journey, from your childhood to till today, which are those couple of things you think that it has worked for you and it will work for most of the people? Anything?
See, the thing is that even when I was getting into engineering, or you never thought about that you are going to be in this kind of a role.
Correct.
But during my MBA, I started investing in stocks because I was doing MBA in finance. I had done CFA, so you want to apply some of the theory and see whether it's working. So we started a fund in the college and started managing, for the students
Mm-hmm.
in college, and that is how the interest began.
Okay.
And then I got hired on the
Mm.
buy side, which was again, everything is luck, is what I say at the end.
Mm.
And obviously, again, there also struggled at the beginning. Like I said, when you get a sector, you
Mm.
have a lot of theoretical experience, but you don't know what to do on the practical side.
Mm.
So you spend that time. Uh, I think being patient, spending time, learning from your mistakes,
Mm.
and maintaining a diary where you maintain, write those mistakes.
Correct.
That is what helps
Mm.
over a period of time. And I think it's a marathon. It's not something
Can be done
which
quickly.
it's not something which I would say that follow this and you will be through.
Mm.
It's more about training your mind
Mm.
to that,
Mm.
right? To buy when things are worse is not easy.
Mm.
But given we spent such a big time in a company where that mindset was developed,
Mm.
so it becomes sometimes easier
Mm.
to do it for us.
Mm.
But generally, if you see, buying when things are worse
Mm.
is not easy,
Mm.
or selling when things are good is
Mm.
not easy.
Mm.
I find more difficulty on how to sell
Mm.
when things are very good.
Correct.
So that is the biggest problem I face.
Mm.
At what time to,
Mm.
that is a different art,
Correct.
which some people do very well,
Mm.
and some people struggle
Mm.
when to lighten up.
Mm. Mm. So let's say suppose if you want to go back toward those maybe engineering MBA CFA days, what couple of things you would change, considering what you have, like.
I think I'll not change anything. It was a different struggle,
Okay.
to because I was good in maths, but I wanted to, and as a result, I did CFA. See,
Mm.
being an engineer, and why do you want to do a CFA?
Mm. Mm.
Right? Because the thing I did is I wanted to enter into finance, so I did a CFA,
Mm.
so that if I get into an MBA,
Mm.
at least I get selected for some finance companies,
Mm.
right? So few plannings I did before
Mm.
getting into MBA, so that I am able to fall on the right side.
Mm.
And MBAs are completely luck. How where
Yeah,
do you go?
correct, correct.
So and generally people don't have idea. So
Mm.
if you see people or some of my juniors who come out of college,
Mm.
nobody has a clue where they are
Okay.
getting into.
Correct,
They
correct.
get into it, they spend that 2 years time, and then they get to know that, okay,
Mm.
this is not what I want to do, right, to build my career. So luckily for me, I was in a role where I liked that role,
Mm.
and I wanted to make a career out of him. So from that point of view, I was lucky, so I will not want to change anything.
uh, really appreciate Suraj. I think it was really a full, wholehearted, free flow talk,
Yeah.
and I really appreciate that. The whole idea is basically let's I think this is one space is exciting, but at the same time, I feel that people might get into a trap with the wrong notion, with the
Yeah.
wrong sort of expectations. The idea is that let's have some free flow talk so that people can, investor can benefit of that, and obviously people who are young can benefit for your experience.
Yeah.
So thank you so much for your time,
Thank
you
you.
know, like, and really appreciate for
No, it was
talking.
a wonderful conversation.
Thank you,
Thank
really
you.
appreciate.
Thank you.